Hello, everyone, and thank you so much for taking the time as well, especially for giving up some of your after work hours. I think that's probably the hardest because you've had a long day, but spending some of your Tuesday with us. A little bit of housekeeping before we dive in. If you've got questions at any point over the next 45 minutes or so, just drop them in the Q&A and we'll answer them as we go because it'll be topical. It'll be a little bit more collaborative. We want to make this not just a session where the three of us talk at you for the next 45 minutes. Obviously, the reason why we're here, we briefly touched on it, is there's been a lot of tax changes over the last couple of months, right? There was negative gearing, there was capital gains, there was super that was announced a couple of weeks ago that kind of rattled the population a little bit more. And you're sitting there, probably a lot of you may be sitting there thinking, is property investing kind of done in Australia, right? That's kind of the headline question that's happening quite a bit. I know it's happening a lot at Alaya Property. And tonight, I guess, across the three of us, our job is to show you what some of these opportunities look like, how we're thinking about it as three different adjacent professionals who sit in the property space, and what 2026 kind of looks like, or 2027 or 2028, right? And I love the fact that I don't have to do this alone, because a lot of the time I'm sitting here sort of talking to a camera, but I love that I can have a session with two of the best in the game. I've got Ash Chowdhry here from Embark Financial, who will take us through like funding and lending. And I've got Roger here from Trident Financial as well, who knows structure and tax like no one else. So between the three of us, hopefully you'll walk away with a really full picture of what these changes are, what these changes mean. And the best part is we've also worked on a document for you guys that took us a couple of weeks to finalize. If you stay till the end, we'll pass this on to you. I think probably get delivered into your inbox sometime tomorrow. And you'll see it'll capture some of the details of, I guess, what we've spoken about tonight, along with some of the suburbs, et cetera, markets, which I know a lot of people get interested in, that Alaya is thinking about in response to what these changes look like. Yeah? So let's get straight into it. Gents, do you guys want to do a quick intro? Ash, maybe I'll go to you.
Sure.
All right.
As you got.
Oh, okay. Thanks, Ash. You gentlemen. G'day, everyone. Roger from Trident Financial Group. I'm one of the partners there. So I've been in practice for, nearing on 15 years. So we, every day of the week, work with investors and small, medium business owners around their businesses, around their investments, around their, property, equities, all of the stuff that they're investing in, including self-managed super funds. So we have a lot of fun doing that. A lot of my time is spent in making sure we get the structure right, because that sort of sets the framework for everything going forward. And then I've got a team that supports me in making sure we can get the smallest amount of tax paid by clients, so they can continue to build their wealth and achieve their goals as a family. So that's me in a nutshell. Over to you, Ash.
Thanks, Rog. Ash Chowdhry. So pretty much about 20 years in banking. So a whole heap of different roles across NAB and ANZ, consumer lending, home loans, commercial, business lending, etc. My last role at ANZ was head of home loan sales. Plan was always to start my own brokerage, and I took the leap last year. So I pretty much left ANZ in September 2025 and started the brokerage, been heavily involved in all things construction, development, property investment, really passionate about all things real estate. And so it was just a question of when, absolutely loving it. It's great to be so much more hands-on with my clients and get the opportunity to kind of inform a much more holistic strategy for my clients, as opposed to thinking of lending in finance in a very transactional manner. So Embark Financial is a full service brokerage, so we do all types of lending, but our core segment is definitely property investors. And it's going really well. Obviously, a very interesting time to start a business. We're heading into 1 year mark, and it's been very interesting. But it's great to be able to partner with the likes of Artie and Roger as well. And looking forward to this conversation.
Yeah, beautiful. I should probably give a quick intro to myself as well. So I'm Addy. I run Alaya Property. We're a buyers agency. We're a national buyers agency, primarily dealing with property investors as well. And we have the pleasure of working with Ash and Roger in the background because, we sort of think of property investing as a team sport. It's very hard to do things like in isolation. So you need to have the right structures in place. You need to have the right lending options in place. And it's definitely been an interesting time for us as well, because obviously we navigate a lot of different markets around Australia, and the changes obviously brought questions that we probably hadn't had to contend with for the last couple of years that we've been running Alaya Property. So saying it's interesting is probably the mildest way to put it. But I think over the next 40 minutes, we'll unpack some of the nuances of what's come about. So what we might do, just to give everyone like a bit of a platform to start from. Why don't we just talk about what these changes are? Like, what has happened? Let's just define them specifically, and then let's talk to them. Let's talk to them like directly as well. So maybe Roger, I might pass it on to you, man. Let's talk about negative gearing changes. Let's talk about capital gains tax. Can you give us your Cliff Notes version? What has actually happened? Why is everyone so like up in arms about it?
Brilliant. Absolutely. So as a property investor in Australia, we have this amazing concept called negative gearing. So I'm going to target this to someone that may not actually know what negative gearing is. So what it allowed us to do is allowed us to reduce our personal taxable income based on any investment losses that we generate in holding a property. Because property is so expensive, we generally, with depreciation included, there's usually a minus number, and then you can offset your taxable income to save tax, right? So with the changes, the government's come out and said, hey, we don't want that anymore. We're scrapping negative gearing. So that's number one of the biggest changes, because negative gearing's been around for a long time. And the last time they scrapped it, they reversed the scrapping because it had such an impact on the market. So time will tell to see what actually happens with it. But as of now, it's gone through the parliament and it's law. The changes are now in effect in regards to negative gearing. The second one is the 50% CGT discount, which is also a huge change, and that just doesn't affect property. It affects every single asset class. So whether you're owning shares or bonds or managed funds, whatever it is, you no longer get the 50% discount. So you're entitled to the 50% discount under the old system if you held an asset for greater than 12 months. Now, for long-term gains, it's moving to an indexation model for individuals and trusts. And then if you're a company, you don't get anything. But in the past, you never got anything anyway, so it doesn't affect companies. But as an individual, which a lot of people invest as individuals, that 50% discount benefit is gone. So it's not all doom and gloom, because what it's being replaced by, indexation, it does have advantages if you hold for a long term. Sometimes you're actually ahead, but that doesn't apply for everyone. And a lot of people who invest in property, they're not necessarily going to be holding it for long term. But if you do, the indexation model does often come out on top. So that's number two, which is no CGT. And number three, which is around trusts, which is still proposed and it's not yet law, so I won't spend too much time on it. But if you invest through trusts, in the past, you're able to distribute income and gains, but now they're applying a minimum 30% tax on trusts, which changes the game a fair bit with how you use trusts. And to some degree, it may even kill the idea of investing via trusts, but there still is a place for trusts, which we'll get into down the track. And as a side note, outside of the three main changes is the SMSF borrowing, which I won't get into too much. Ash might talk to that. They're effectively no longer going to support that after, I believe it's the 14th of August. So that's the key changes. So that was a lot really fast. And as Artie said, if you wait till the end, there's a handout which breaks down all of the details. But the long and short of it is these are fundamental structural changes that, we haven't had this level of change in a very long time.
Yeah, I think just to put my 2 cents in there, it has been really interesting. So one of the responses that we did as a company, we were like, wow, how do you even navigate something like this? And the initial response is, oh my God, everything's over, right? Negative gearing's gone. Like for most of us who've been sort of, I'm 36, for most of my life, or at least my investing life, these concepts have been around, right? So it's been quite difficult to contend with, wow, how do you go from something so fundamental to something that doesn't exist like that anymore? So one of our responses to this was we built a calculator in the background, which allowed people to just sort of navigate the numbers. And I think that calculator and I guess what was coming out of it was a really good representation of, it's actually not the end of the world. Because like you said, Roger, there's nuances to this, right? It's not that CGT has been scrapped as a concept. What has happened is that the model has gone back to like the 90s, right? Before because that's how it used to be in the 80s and the 90s, right? When CGT was sort of introduced, it went through the indexation method. Then one of the governments, as the Hawke government or the Howard government, introduced the 50% discount. That's been in place for like 30 years. So we are used to it. For most of us who are like, in our 30s and 40s, that's what we are used to for most of our investing sort of lifespan. But yeah, it's not the end of the world. And there are nuances to it, because if inflation is running high in the indexation sort of process, that's actually a good thing. in the context of like capital gains, right? So there's all of these nuances, and I think once you get the handout, you work through the calculator, it'll be a good indication of, does this mean that, you know, capital gains is no longer around? So it's just not the case. So I don't know. What are your thoughts, Ash? What are you seeing from a lending perspective?
Yeah, no, look, I mean, I guess the only other thing, and I'm sure, Rog, you're going to talk about this more, is just from a negative gearing point of view as well.
Yeah.
The reality is, in a way, you can still bank those losses. So those losses haven't completely gone away as well, right? So I think, again, that's going to be something that people are going to keep getting across and keep understanding the nuance of that as well, and how does that come to effect when it comes to capital gains, selling, you know, keeping a property and maintaining the debt. Look, from a finance point of view, obviously it's been fundamental change across the board as well. So the biggest change is definitely your borrowing capacity, right? So with negative gearing removed from your servicing calculators, etc., across the lenders, that is a substantial drop in the borrowing capacity and servicing for a lot of property investors. So I think, yeah, look, we'll see how it all kind of pans out, because again, it's a very dynamic environment as we were talking about. Lenders are still adjusting, and look, it's still very early days in terms of how it's all going to unravel. But I mean, top line, you are seeing, 15, 20% drop in servicing and borrowing capacity. And again, it depends on the individual, it depends on your circumstances, your debt, your income, all that sort of stuff. But again, I think it also highlights, look, there's just so many options there as well, right? So I think the more that property investors kind of get across the new landscape, the more conversations, the deeper the advice that you kind of seek and have in the current market, in the current environment, the better informed you're going to be. So I think, if there's one sort of good thing about the whole thing, we're talking about a fundamental change, but equally from my perspective, from a finance perspective, it's good because it does mean that there's more emphasis now on getting the fundamentals right? So even from a finance point of view, you want to make sure you're looking at your buffers, you're looking at your cash flow, you're making sure, you've got a plan. So as I kind of said at the start, it kind of moves away from thinking about property investing and the finance as a transactional thing. And, I've just got to go and get a loan and buy a property and, borrowing capacity is going to be fine. Finance is going to be fine. You want to make sure you've got a plan. You want to make sure you've got the right team. And look, at the end of the day, property investment is a game of finance. Like, you want to get the finance right. So yeah, it's a fundamental change, but equally, in a way, it does kind of, like I said, focus back on the fundamentals. And from my perspective, that's a good thing. So, make sure you've got a plan.
Yeah. I think, what's really interesting though, we've called it a structural change, we've called it a fundamental change quite a few times. This ain't the first one though. In the last 20 years, we've had the Royal Commission come in, right? So that completely restricted what borrowing looked like for so many people. The happy years of 2010, 2011, where you could just go out and get whatever loan you wanted. That doesn't exist anymore, right? So that was a very, very fundamental change. Now that was what, Ashwin, you might be across this, or you guys might be across, was 2017, 2018, when Royal Commission was sort of introduced into the process. That was, people were freaking out. People were like, oh my God, we can't borrow in the same capacity anymore. Property prices are going to tank. Now we've seen what's happened over the last 9 years, right? Yes, of course, a lot of these pivotal changes in our history have brought about a short period of correction, I guess probably the best way to call it, right? So people start to, hold on to their cards a little bit more. They don't make decisions as fluidly as they might have at one point. But property prices have still gone in the same direction. It's the same thing though. It's we might come from a biased perspective, but the fundamentals of property investing has not changed. It's a supply, demand, and affordability sort of framework, right? That's how it works. It's a commodity like anything else. If there's not enough of something and a lot of people want it, and for a certain segment of the market, it's still affordable despite the 20% borrowing capacity drop, you're still going to be okay, right? So if you look at markets, I mean, what we are seeing on the ground in terms of property specifically, not lending, what people have done, they've just pivoted to the more affordable markets. This is kind of what happened through COVID as well. We had 13 or 14 different rate hikes. Affordability got, crunched, and people were like, oh crap, our borrowing capacity has also been sort of hit. But that's when markets like, the Perths of the world, the Adelaides of the world, the Brisbanes of the world went through the roof because they were the only ones offering affordable opportunities. So when we sort of said at the start that this is just there are still opportunities, but you just have to pivot. You just have to sort of, it's sort of like a game of boxing, right? It's a fight of boxing. So you can't just sort of react to it and be like, oh, this is the end of the match. No, all you have to do is, you slip and parry and you just get on with it. And that there's a round 2 and there's a round 3. You just have to think about it a little bit differently. And that's kind of what the opportunities are for us. Like since May the 12th, we've probably onboarded something like 40 different clients. These people are not coming into our books because, they're thinking property is dead. They're like, oh, there is just a different opportunity. And probably the headline number everyone should be across, Australian property is a $12 trillion market. For property to tank and for property to go to zero, whatever the crazy sort of headlines are out there, this would have a fundamental impact on the economy of Australia. Property is far too big a piece of the puzzle, of the economic puzzle, for it to completely tank. So just fundamentally, the Australian government, despite all the changes that they're putting in, they cannot tank the market. It is just not feasible. There are industries based off this singular industry, building industry, construction industry, property management, real estate, whatever it might be. They're all underpinned by a $12 trillion sub-economy. So just be mindful that for the property market to tank, a lot of people will lose their jobs, right? And between the RBA, between Canberra, that's not what the intention is here, right? So yes, there are small corrections that might happen as a result of the changes. It's definitely not going to change the game itself. So yeah, crazy times.
I might add one thing. You just triggered me to think about this. A little while back, I delivered some training on stamp duty and land tax. So if the transactions reduce, the amount of revenue the states generate through stamp duty and land tax, land tax will be extant, but if the values tank, land tax will reduce.
Correct.
But stamp duty revenue will also reduce if the transactions drop, right? So the states are reliant on property still being economic and like a viable industry. So whilst the federal government is trying to, they've made a risk assessment and they've thought, you know what, there's too much happening in the property market and we want to try and put the brakes on it. There are still competing forces even at the state level. States want properties to transact because every time it transacts, they collect stamp duty. So I think it's a cycle. I think that's a key thing to appreciate. And even some of the things that you said, Artie, there used to be indexation and now then there was CGT discount and now there's indexation again. There used to be, different mechanisms over the years that have gone by that have impacted property as part of the cycle, right? So we're just in a different cycle and different rules, but it'll come in swings and roundabouts.
Exactly. You know what's really funny? So I've been, over the past week or so, this is a complete random thought that I had. I've been building out Alaya's website. I don't know if I should say this publicly, but I hate our current website. So I've been building it out. And one of the things I really wanted to build out, I just wanted to show people what the history of property has looked like, going as far back as we can in terms of where data integrity was still a thing. I still have confidence in the data. So I think it goes back to something like 1970s or I think like early 1970s. So we're building out this 55-year picture of what property prices have done. And it's so funny. You sort of map out as you can imagine, it's only gone this way over time. If you zoom in, there's always these little dips that have happened. But when you zoom out completely, like you said, Roger, not everyone wants to invest in a 20, 30-year time frame. But really, to me, property investment has always been a long-term game, right? Most of the assets that you potentially want to accrue are for the long term, unless, of course, you're buying in your 50s and 60s. But really, if you're astute, if you're sort of well-informed, you should be buying in your 20s and 30s and 40s. Anyways, you zoom out, and it's just fascinating to see the numbers that have sort of come about. Like you look at the 1970s, you had some crazy, crazy times. You had the introduction of the capital gains tax. Like imagine that when that happened, you think people weren't freaking out? They're like, all of my gains have been tax-free so far. Like I think it was 1985 or 1987 where it was introduced. People must have been freaking out. And they were already contending with like 15, 17% interest rates. Then as you sort of follow the mark and you're like, it started off in a 5-figure median house price for Sydney. You're now looking at a 7-figure, nearly like $2 million median house price for Sydney. Over time, Australian property has only ever done one thing. It's gone up, right? Of course, there have been corrections because of these major changes, but it's so fascinating to see it over the 55 years. And it's just like, God, when you look at this chart and you do have a 20, 30-year horizon, let's say that's part of your sort of strategy that, might have worked out with Roger and Ash. Like, there's no reason why you would think that property is no longer the vehicle that it used to be, right? It just doesn't make any sense. So I just found that really fascinating. So once the website is live, I'm excited to sort of, get it into the hands of people to actually help them see what has transpired over the, last 50 years for Australian property. Hey, Robbie. Can you see that question?
Yeah, I can see that question. There's a tax question here. Is there any benefit anymore in purchasing a property under a trust or a corporate trustee structure over a company now, from specifically a tax and BC retention? Sorry, the comment just disappeared, but I think I got the gist of the comment. So the short answer now. So the question is a trust still an effective vehicle to invest in property? The short answer is it depends, and it's a political answer. It's a politician answer. It just depends on your circumstances. It depends on your family income, and it depends on what else is going on. So let me clarify. So if you're just an individual and you just work PAYG and you're trying to increase, say, your borrowing capacity by using structures, would you go a trust or would you go a company? If the lending policy allows you to do the same in a company will probably make more sense than a trust, right? But in the company, you lose the indexation, you lose a couple of other things, but it allows you to retain income, right? But as a trust, you've got the 30% tax on gains and then the CGT flow through, or the post CGT flow through. So there's pros and cons, but the general thing that we are seeing up in our modeling that we've done in-house, because, as soon as budget is released, we look at, well, what have they missed? Is there any workarounds, and what do the new structures look like? In our modeling that we've done, it seems that companies are coming out on top at the moment. But the question is, who then owns the company? Are you going to own the company in your own name, or are you going to own the company in a trust? And then again, that's another question that needs to be answered with a qualification. It depends on your circumstances, on whether you're an at-risk individual. Right now, someone who's running a business that might be a company director, or someone that might expose themselves to liability because they're providing services, or are you likely to become an at-risk individual? So if you're entrepreneurial and you want to open up a business one day, but you just haven't right now, having it in your own name, for example, the shares of the company, that might not be a good idea down the track if you end up, getting into a business that might expose you to risk. So then in that instance, you might want to put those shares of that company into a trust, right? So the structures have to somewhat suit the circumstance and the objectives, but the short answer is our clients are moving to company ownerships of properties. That's the short answer. And then depending on if they're at risk or not an at-risk individual, those shares are owned by a trust, usually most of the time, because, a lot of people that are ambitious property investors have that level of ambition that they may start a business sometime down the track, or they may have a side hustle or something like that might create some risk in their life, and it's not worth betting the house on it or putting the house in the basket of what the creditors can access if something goes wrong.
What are you seeing, Ash, from your perspective?
Yeah, look, specifically around buying an entity, whether it's a company or a trust, specifically from a budget point of view, there's no really changes when it comes to kind of finance, right? So it's essentially the same thing. But in saying that, again, like I said before, it's a very dynamic environment, right? So trusts and changes to trust kind of came through late last year with a lot of majors kind of making changes. There's a whole heap of kind of conversations and some changes potentially coming through. Some lenders have already kind of made some changes around getting a full holistic visibility of an individual. So what that means is in your credit report, you can kind of potentially start seeing some lenders provide visibility of if you've got debt as an individual, if you've got it across different entities, trust companies as well. So I think it's a very dynamic situation in terms of the trust and the company borrowing side of things as well. But fundamentally, as of now, from a pure budget changes point of view, it doesn't kind of change the finance and the options. Again, it's a very nuanced situation and thing to kind of work through. So look, obviously from a broker and a finance point of view, we work closely with the accountant, with Roger and his team. And you want to make sure you're kind of looking at things holistically, right? So there's a whole heap of other considerations, like you mentioned, Roger, land tax and other considerations that you've got to kind of work through as well. But while we're talking about entities and structures, I think one of the main points to definitely call out is, depending on where you're at in your investment journey. And, I think we're going to work through a few different profiles and stuff as well. But if you've got kind of that one property in your personal name, potentially two properties in your personal name, it's definitely the time when you start having and getting across all things trust and entities and company and having that conversation with your accountant in case you already haven't had that. Because again, a lot of the challenge that people have is they kind of exhaust their personal borrowing capacity and then think about trust and company, and in a lot of ways that's too late, right? So when you need to make that transition and when it makes sense for you based on your situation, you definitely want to do it when you've got some buffer left in your borrowing capacity. So again, back to the point that I made before, the conversations that you're now having, have them much sooner with your broker, with your accountant, and obviously make sure you've got a good team. But also, kind of make sure you're working through all the different trade-offs and considerations, because there's definitely no single formula. It's a very fluid sort of environment at the moment with the lenders and how they're assessing. And again, there's a lot of options. So a lot of the majors, they're very restrictive when it comes to borrowing in a company and a trust, but a lot of your non-bank lenders is where, when it comes to scaling your portfolio and your investment, particularly in SPVs and structures, that's where you start looking at your non-bank lenders and your tier twos.
Yeah. It's so funny. I feel like you were calling me out, Ash. I was like, oh, that's a bit personal, because I was the guy who started off building a portfolio in their personal name. To be honest, I didn't, in my early 20s, I had no idea about structures, etc. So like 3 properties in, I went back and, I was like, oh, there's no more borrowing left. I didn't even know that was a thing, to be honest. So I was one of those very people who understood the benefits or advantages of having conversations early. It took me making the wrong decisions to land on the fact that, the right decision is just having those conversations early. But Robbie, I think from my perspective, man, I'll probably provide 2 things here. So personally, I'm actually looking at liquidating a lot of my personal name assets at the moment and potentially gearing towards like a company structure. That's just a personal thing that I'm doing based on my circumstances. The second thing, each of the answers that Ash and sort of Roger provided, you could see there's a lot of nuance to them, right? Now, I don't know about you guys, but I see a ton of ads on my meta feeds in Instagram, whatever, where people talk about things almost in absolutes. Company structures is how you should be buying. Trust is how you should be buying. The only thing I would like you to take away from this is there's a nuance to it. There's questions that you need to answer that you might not even have answers to yet. Are you entrepreneurial? What does asset protection look like for you? Are you planning to build a portfolio of 10 properties? Because not everyone is. You might think everyone wants a 10 property portfolio, but not everyone does. Maybe people just want 2 or 3 just to get them to the goals that they have. So there's a real nuance to it, man. And the only way to actually answer the question for yourself is to get in the room with both your broker and your accountant and figuring out what exactly it is that you're trying to achieve. It's a very political answer. It's a very almost non-committal answer, but nothing annoys me more than seeing absolutes when absolutes don't apply across the board. And it is just, people get drawn into or sucked into these environments where they're like, oh, I'm going to go and set up an SPV and I'm going to go and set up a company structure. And I'm not going to think about whether if the director is me as a personal person, as in my personal name, or whether it's a corporate trustee. All of these little things have an impact on what it looks like for you in the next 10, 15, 20 years. But if you don't know how to ask the question, or if you don't know who to ask the question of, you might get sucked into it because some ad told you company structures is the way to go. So just be really, really mindful. It's all nuance based. And the best person to ask would be Roger and Ash in terms of how you go about doing it based on the goals that you have.
I might add just one thing to that, Artie. So with the trust, so the way the government have written it at the moment around the indexation is if you are a non-resident for even one single day, you lose the indexation. So let's just say you buy a property in your personal name and you have it for 15, 20 years, and then you leave the country for a period of time because you have a secondment or you have something happening overseas, you're attending to family, you come back, all that indexation is gone. So your cost base is still your cost base, which is awful if it's in your personal name. So then in that instance, if you know that you're going to hold it for a really long time and indexation matters to you, you might stick it in a trust, right? Because then the trust gets indexation, but you might substitute the trustee of the trust. So whilst you're offshore, the trust can still accumulate indexation. So there's so many little bits and pieces of nuance that you need to cover off on before getting to a final decision.
Yeah. We have some support in the background. Thank you, Haley. Very kind. And Jimothy. Jimothy is long for James. What's the question, my friend? And by the way, I don't know if this is relevant, but Jimothy is a very new dad. He had his first bubs 3 days ago. So the fact that he's here tells you a little bit about his priorities. Go, Jimothy. What's the question, man? Or maybe we'll wait for the question to come through and then we'll tackle it. I think someone talked about profiles here, right? I think profiles is probably a good thing to tackle next because a lot of people in Australia obviously fall into different archetypes, I guess, income-based, goals-based as well, what it kind of looks like, what your cash flow looks like. So why don't we go through some archetypes, typical archetypes, so whoever's watching this, whoever's listening to this can find themselves relating to something specific. So why don't we go through that? So maybe as the first one, this is probably the most typical profile that we get at Alaya. So it's sort of like the first-time investor or maybe the second-time investor. They haven't necessarily thought through a lot of their portfolio plans. That's why strategy is a big part of what we do here. They earn anywhere between $80,000 to $120,000, right? Obviously, it's a little bit restrictive in this sort of price range. So the max they can really go for is a 500, 600, sometimes up to a $700,000 property because they go with non-bank lenders, depending on if their broker is a badass like Ash. That's probably the profile that we start with. What are your thoughts? Maybe Roger, I'll start with you, man. Maybe if you're in the 80 to 120K bracket, you're looking at a $600,000 property. You are thinking about growing a portfolio. Let's say 4 or 5 properties. How would you be thinking about it, Roger? And it's my first property. I haven't bought one yet.
Yeah, sure. So if I'm speaking to a first-time investor and they're having a chat, Rog, what do I need to think about? It's almost, I need to actually understand the individual's risk appetite. People sometimes go, hey, I want to have 5 properties, but they don't actually understand that there's a lot of moving parts when you have 5 properties, right? You've got notices coming out of your ears, land tax, you've got council rates, you've got all these things to think about. So I sort of try and understand, hey, you sure? Are you ready? And usually the answer is yes, because they've thought about it. But I always like to try and give the perspective of, hey, think about what it is that you're aiming for and make sure you fully appreciate what it is that you're aiming for. So let's assume that, 100%, I'm all in. I want to get 5 properties. Well, then the other thing that I also consider is what profession is that individual and what's his income growth potential as well. 80 to 120,000, if he's a nurse, that's entering into his career. I know there's nurses that earn up to 200 grand, for example, with overtime and they've got specialist qualifications that they've done, right? Or if you're a doctor or a trainee doctor, it could be a different figure. Or you might be an accountant working at a Big Four or something along those lines. So all of those things determine like an income projection as well. So I sort of look at that and then go, hey, make sure that like you speak to an Ash to see how that's going to work. But from a structure perspective, usually the first one, most people are so unfamiliar with structures. The idea of structure scares them, right? Unless they've got family that are in business, unless they receive trust distributions, maybe from their dad's trust or something like that. The idea of having a company when you're early on in your career or maybe not quite there yet, it's quite scary. So you have to also appreciate, is the individual ready to handle being a company director and all the paperwork and admin that's involved? Assuming all of that's good, then we just have to make a decision. Are they an at-risk individual? Are they likely to become an at-risk individual? And then what type of property entry points are they looking to get into? And then we just have to make a decision, company, trust, or individual name, or SMSF if they also want to leverage.
There's actually a few different questions coming through. I think another one for you, Roger. You seem to be the more popular one. No one's asking. I mean, Jimothy's asked about some suburbs, but Ed's asked, how about for an Aussie expat? Can they buy in a trust or company given they are not an Australian resident and cannot be a director? It's a pretty technical question.
It is a technical question, but we actually have an expat specialist, ex-KPMG at Deloitte. Ernie, we've been advising expats. We've got a big expat client base actually at Trident. So it kind of depends on what your intentions are. If you're planning to stay, if you're planning to become a PR, if you're planning to become a citizen, and you are correct in saying if you don't have a resident director, then your trust or your company becomes a non-resident entity. That creates a whole series of complications. So it's a bit more of a broader question. I don't want to mislead you by giving you a simple answer for a complicated question. What I would say, and I'm not trying to upsell my services here, I genuinely encourage you to speak to your accountant if they've got expat experience. If they don't, reach out to our team. I'll connect you in with Ernie. Like Jimothy, Ernie has just had his first child on the 30th end of financial year. So he's an accountant. He's got an end of financial year baby. So he's a little bit occupied, but as soon as he's back from leave, you guys should catch up and go through your circumstances specifically. So it's a non-committal answer, but there's a lot of nuance to that specific question. And Australia, if you haven't seen from a policy perspective, they're trying to make locals preferenced when it comes to their policies. And expats, for example, like expats lose the main residence exemption. They've lost a lot of the benefits of what a local would get. So it's important that we analyze your stuff carefully. What's the next question there for me?
The next one is actually, I might even hand over to Ash. I mean, Pia asks, what are the biggest mistakes first-time investors make with finance and property investing, and how can I avoid it as a 22-year-old just looking to get into the market? I love that question. I was 23, Pia, when I bought my first one. Made every mistake in the book, apparently. But Ash, I mean, what are you seeing? You work with quite a few young investors as well. What are the things that they're doing well, and what are the things that they should be avoiding if they have certain ambition?
Yeah, no, that's a really, really good question. And look, I mean, for that profile at that age, first-time investor, you just got to keep things simple. Again, like I said, you've got to focus on the basics, you've got to focus on the fundamentals, you've got to have that finance conversation with your broker early, understand exactly what your borrowing capacity is, even before you start thinking about the property and looking at properties and that sort of stuff, right? So speak to your broker, speak to them nice and early. Get a pre-approval, get a proper pre-approval as well. I think that's really important. Again, given all the changes, as I mentioned, a lot of lenders will essentially give you a very different view of what your borrowing capacity is, right? So I think, again, when you're a first-time investor, when you're getting into finance and getting across all the different lender options that are out there, again, depending on what your circumstances are, your income, your risk profile, etc., understand the fact that there's a whole heap of options out there, and that you've got to also understand what are all the different things that actually have an impact on your borrowing capacity, right? So again, when you're in that profile, your credit card limits, your personal loans, your car loans, whatever debt you've got has a significant impact on your borrowing capacity. So again, getting across and having that understanding, having that conversation with the broker, that is really important at the start. But yeah, I think, look, like I said, at that age, you've got to be clear on, but also making sure that you've got the right advice, right? So again, focus on getting the buffers really strong. I've seen a lot of investors, first-time investors who kind of essentially stretch themselves pretty thin in the first purchase itself. So again, it's really important you're not stressing yourself too much. You're making sure you've got the cash flow, you've got the buffers there, you understand what those holding costs are. You can plan for if there were a couple of rate rises, what does that actually look like on your cash flow, on your liquidity and all that sort of stuff, right? So again, just focus on the basics, make sure you've got a strong foundation in place, get the right expertise, have that conversation at the start. And yeah, I think, look, it's when you're making that decision, like rent vesting is certainly something that I know has been really popular. And again, with all the changes, again, you've got to essentially evaluate that. But again, as a first-time investor, from a finance point of view, there are multiple options you can also consider, right? So whether it's looking at a guarantor, if you haven't got the deposit, there's plenty of options there as well. So long story short, what I'd say is definitely for that profile, have that conversation, have it nice and early, understand what are all the different options, understand what the trade-offs are, and just make sure you've got a very solid foundation in place. And also, you make sure that whatever that decision is that you take for the first property doesn't block you for the second one. If you've got that ambition, if you've got aspiration, if you want to build a portfolio, whatever that might be in whatever years and, how your income's going to evolve, etc. But it's very important you understand that you get the right structure and you don't block yourself with the loan that you get now. So again, think of it as a plan. Get the broker, get your accountant if required, the buyer's agent, sort of pull together that strategy and that plan for you. So move away from thinking about property investing as a transactional thing and think about it as a longer term decision, as a strategy.
Yeah, really, really good answers. Pia, firstly, the fact that you're here on a Tuesday evening is a good indication of, I guess what your mindset looks like. I think that's the number one. We should acknowledge the fact that when I was 22, I was not attending webinars with a bunch of mortgage brokers, accountants, and buyer's agents, right? So that's a fantastic first step. Just educating yourself in the process. I think that's huge. And again, I'll just probably recap some of the other guys. Property, even though, like, look, I don't know, I'm seeing Ash, Roger, and Addy, like, as myself, in the right order. I think that is kind of the order of what it looks like. So before you ever approach property investing, there is an order you need to follow. A lot of people come to us as buyer's agents and they're like, oh, I want to buy a property. But then you look under the hood and they haven't really done the homework to understand, the structures, the lending, and all of those options available. Property is the final piece of the puzzle, right? You have to have a bunch of other stuff sorted out before you ever think about, oh, this is the property I want to buy. People do it the reverse way. People go and find a property on REA or Domain and they're like, oh, let me retrospectively fix my structure and my lending with that. Not the right move. So talk to Ash, talk to Roger, or the Rogers and the Ashes of the world. Understand exactly what you're trying to achieve, and you won't have answers to a lot of this. We're not expecting a 22-year-old to be like, yeah, I want to have a 10 property portfolio by the time I'm 40. You might not have that answer, right? But it's still good to ask those questions of your broker, or let the broker ask it of you, or your accountant ask it of you, so you can start formulating some thoughts around it. And then that first one, I guess the biggest part the first property can play for you, Pia, is if you get everything right? If you sort of tick the boxes doing your homework, technically, or this is kind of what happened to me, you never have to really save for a deposit again. That's exactly what's happened to me, right? I haven't built a portfolio on the back of saving deposits each time. I have bought well, apart from the very first one, which we won't talk about. I've bought well, I've built up equity, and I've just recycled that equity depending on my serviceability as my income has gone up. I've taken some of that equity and I've gone and bought again, and I've used that equity again to sort of recycle and build up a bit of a portfolio. So if I had to distill this all down, continue attending things like this, educate yourself, have the conversations. If you're in the market, have those conversations early. Don't wait to save up that first deposit. Have that conversation with the Ashes and the Rogers early. Once you've got those things sorted, then find yourself potentially a buyer's agent, or do your research in terms of what it looks like for you, like in terms of what property you want to get into. And huge thing, Ash touched on this, buffers, man, buffers. Have buffers in place. A hot water system shouldn't be the reason you're like, I don't want to do property investing anymore because I'm now broke, right? You need to have buffers in place, and never ever go into your first property having fully capped out your borrowing capacity, right? Never ever do that, because what that does, it kind of restricts you, and you have to rely on a big income increase or whatever it is. You're now being controlled by the market as opposed to sort of being in control of your situation. So those are probably the big three takeaways. Hopefully that helps. We have a few more questions coming through. Jimothy, all right, I appreciate the value and thesis behind the Melbourne metro unit play. Would you consider this a cyclical play? With units on course to rising in value, are Melbourne houses the contrarian play? Unit value rises, the gap to house price narrows, houses run to maintain the price gap. It's a really good question, man. Yes, I think the simple answer is it is definitely cyclical. I think the fact that all three of us are sitting in Melbourne, we've all seen what has happened with the Melbourne sort of unit and apartment market over the last 10 years. It hasn't done much, right? Everything in itself is cyclical, right? If we were having this conversation in 2019, we would think that Perth is probably the worst market ever to invest in. You fast forward a year, you fast forward 2 years, and suddenly Perth is the greatest thing that's ever happened to the property investing market, right? So everything is cyclical. That's just kind of property investing in a nutshell. The reason I have a bullish sort of thoughts around the Melbourne unit play is because the cycle, I think, is starting for this part of the market, this segment of the market. The thing that actually completely destroyed the market was oversupply. That is all it was. It was just too many towers going up all around Melbourne, far too many cookie cutter places, and there was just not enough demand to absorb that amount of supply. But now if you look at it over the last couple of years, we have seen a real crunch in that supply because developers can't make the numbers work anymore. It's just far too expensive. If you think about the rising building costs that have happened over the last 2 or 3 years, I think I've seen this number quoted everywhere, but it's somewhere like 30 to 40% rise in building costs just since COVID. Now imagine that as a developer, you're absorbing these costs, right? You're already working on fixed contracts, you're absorbing these costs. How do you stand up a a boutique sort of 12 apartment thing, 12 apartment block. When you go on REA, you can buy a similar property for like $450,000-$500,000. Like I know Ash and my team are working on a lot of these plays, right? It doesn't mathematically make sense. Now that gap has to come through, right? So that's the unit part. Now the houses, is that a contrarian play? I don't think so. I think houses will always outperform units in the long run, right? So I'm gonna call out Pia for a second. If you just indulge me. If I'm in my early 20s and I have two options, I have the option of buying a house, I have the option of buying a unit, but I'm just starting my career. So my income is at the lowest point of my career than it'll ever be. Now I have the option, I look at my numbers, I run my numbers with Ash and Roger, and I'm like, I can't actually afford a house. I can afford to buy the house, but I can't afford to hold the house. Now the question then becomes, do I just not invest? Do I go put the money into shares and stocks? Sure, you can do that. But then you lose the leverage component, right? And you also, it starts to become hard because the same CGT sort of tax issues that we are talking about, the tax implications, also fall into that asset class as well. So now it becomes a question of whether I invest at all or whether I go down the path of investing in an asset class in the next 30 years is not going to perform the same as houses, but it's the one that I can get into. It's the affordable option for me, and it has some great fundamentals at play. So is it the contrarian play? I don't think so. I think houses will always sort of outperform units in the long run. But to your point, James, in the short term, I do start seeing units outperforming houses purely because of an affordability factor. We've seen this play out in Perth. We've seen this play out in Brisbane. Houses went through the roof. People's incomes didn't change to be able to actually start buying houses at the same level because a lot of obviously interstate investors came into Perth. Same with Brisbane, same with Adelaide. And what happened was they just dropped down to the next more affordable asset class, which is units and townhouses and apartments. And now apartments, units, and townhouses have gone through an absolute surge in Perth. That's what most people are buying at the moment because that's what's affordable. That's what still offers the yields that you want as an investor, or the affordability factor that you have as an owner occupier. So there's probably a few different aspects there, but it will. Yeah, I think in the long run, houses still win. But if you're in the process right now, you're a peer, or you're sort of just starting out in your career, and you don't really have an option to go into a really large negative cash flow portfolio, then yes, I would think a unit makes sense at this point of time. And the really interesting thing is, I ran some analysis last night. In the last 2 months, a lot of the markets that were going backwards in terms of units, or even like flat, have actually started to increase. They're very nominal increases, right? We're not talking about 10% increases or 20% increases. But the Footscrays, the Brunswicks, the Carltons of the world, funnily enough, in the last quarter have actually pivoted to a positive, which is really interesting because they have been sitting flat for a very long time. Footscray, for example, has actually tripled in its month-to-month growth relative to its previous month. So that cyclical structural change is actually happening in the market. It just happens to be very early, so people are a little bit freaked out about the thesis. So bit of a long-winded answer. Hopefully that makes sense. I don't think we're going to get through the rest of our talking points. Let's just keep answering some questions. What do you guys think? You guys, yeah? Yeah, beautiful. Cool. Ed A, what are your thoughts on a house and granny flat play in Dingo, northern areas like Gladstone Park, Tullamarine, Mill Park, Laylaw? I'll take this one. I think it's fantastic, man. I'm probably not a huge fan of building granny flats. Again, depending on where you are in your property cycle. Again, everything is nuanced. The reason I'm not a huge fan of building it is the capital that you put into building a brand new granny flat only helps from a yield perspective. It doesn't necessarily add a lot of value to your property because typically the bank values it at the contract price and you don't necessarily see an uplift in the overall value of the property. Now, this is why it's nuanced. Now, if your property is massively negative and you need to do something that will get it closer to neutral or even positive, then yeah, granny flats might make sense. But if you're in the accumulation phase, and I'm picking on Pia again, right? If I am Pia, if I am building a portfolio, I've just bought my first property, would I go and spend $250,000, $300,000 on a granny flat? Or is that better placed in buying in a second asset or a third asset? Because the capital growth that you're going to get is going to fund the very things that you want in the future, not necessarily adding another $500 to your cash flow, right? In the short term as part of a resi sort of strategy. So the areas that you mentioned, I'm a big fan of Tullamarine, man. I'm a big fan of Mill Park, Laylaw as well. I have no issues with those. But broadly as a house and granny flat play, it really depends, Ed, on where you are in your sort of property cycle. If you're trying to target a very yield play, then yeah, maybe it makes sense. And if it comes with it, again, that's great. I think if we bought a ton of properties where it came with a granny flat sitting in the back, and that's fantastic. As long as the numbers make sense, just be really careful of how the meters and stuff have been set up, because that can get really expensive, as I've learned personally through my own portfolio. Just make sure that you've sorted those things out. But otherwise, yeah, I think it makes a lot of sense if yield is a big factor for you. All right. Shall we get into Georgie's question? Hey, Georgie. Hey, Addy, great webinar. I'm learning heaps from you guys. Oh, I'm glad. My questions were a bit long, but we have currently 4 investment properties across Victoria, Queensland, and WA, and I'm looking at a sub 600K SMSF purchase in Geelong or Mernda. With the proposed CGT negative gearing changes and SMSF borrowing being phased out, I would love your thoughts on which location you would favour and what structure you would consider for continuing to scale a portfolio. Really appreciate your analytical approach and transparency. We'll love your perspective. Thanks heaps, Georgie. Really good question, man. I think there's probably a few different aspects to that. Look, I'm a huge fan. I'll just say it generally. I'm a huge fan of Geelong. Geelong is a powerhouse of an economy. I know Ash and I, we've probably done some deals, like my company and your company. We've done some deals in Geelong. Yes, there are probably different parts of Geelong that you're going to be careful of. Bell Park, I'm a big fan of. Newcomb and Hamlin Heights, I can't remember the data from the top of my head, but Geelong as a whole, it's fantastic. Now, the only thing you have to think about, Georgie, is firstly, congratulations on 4 properties. That in itself, I think, puts you in top 10, 5% of investors in Australia. I think that's amazing. So kudos in terms of achieving that already. If you're thinking of SMSF broadly is a long-term game. You have less than 3 weeks to secure something. So just really, really make sure that the property that you're going to buy has done the due diligence, and SMSF by its very nature is now long-term. It's been enforced as a long-term play. You can't recycle equity in SMSF, and not that it's going to be available to you post 10th of August anyway. So what I would be thinking about, Georgie, Geelong, yes, as a holistic 20 to 30 year play. The part that you need to get really, really careful with is the due diligence that you do, because the last thing that you want is to find out in a year that it needs a bunch of structural changes, because that comes with its own complications when it comes to SMSF. Just be really, really careful of that. Mernda, again, I'm a big fan of. We haven't personally, like as a company, we haven't bought townhouses and units in Mernda. It's a little bit outside of our sort of, what do you call it? Diameter? I've lost my maths terms. It's a little bit outside. Perimeter, that's it. Perimeter. That's not diameter. Perimeter, right? So it's a little bit outside of it. So I don't know what the townhouse and unit play looks like in Mernda, but it's the same thesis though. If it's a 20, 30 year play, generally Australian property has gone up, 5-6% year on year. You're probably not going to go wrong as long as you're looking at it in a 20, 30 year play. The part that you need to be really careful of is how you do your due diligence getting into that property. Bit of a generic answer, but I hope that hopefully gets you thinking about how to approach it over the next 3 weeks. What are your thoughts, Ash, on Robbie's question? Hey, Ash, how do house and granny flat properties play out when it comes to valuation/growth over time? You're on mute, man. Ash.
It's been a while since that happened. Yeah, look, I was just saying it's actually a really interesting question, and there are differences across a few different lenders. Some lenders treat granny flats very differently, and the rental income it's assessed very differently as well. But back to the point that Adi made before, the first thing kind of just qualify is, again, granny flats in most instances is a cash flow play, not necessarily a capital growth play. So again, when you think about the valuation side of things, the valuation is looking at the land as the capital growth play. And then the banks and the valuers look at comparable properties, so similar properties, right? So again, it's a combination. So you'd be looking at what's the improved value of the structure, which is where the granny flat as a separate structure on the one title kind of comes in. But the actual appreciation that happens is the actual land component. Right. So again, you've got to kind of be very mindful of that. So, it doesn't necessarily mean that if you've spent, 150 grand building a granny flat, you will essentially get, a significantly more amount of money in your valuation. Because again, you've got to be mindful of the actual capital growth from the land. And also just be very mindful about the actual comparable properties, similar properties in your area. So It's a very nuanced answer as well. And again, if there's areas where you've got a lot of brand new flats, again, you can be a little bit more confident that the valuation side of things will stack up. If you've got areas or council regulations where brand new flats are a bit hard, it does complicate the valuation side of things a bit as well. So just going to be mindful of that.
Beautiful. I think we're basically at time. I know there was a few other things that we wanted to go through, other profiles, but is everyone happy to stick around for another 10 minutes? Or how are we thinking? I think the biggest one I wanted to say was mistakes that we are seeing people make in our own lane. I think that's probably a key one that we can quickly cover off. But how's everyone feeling? That's true. We can probably carry over. We can make this into a part 1A, part 1B if you guys want. But some really, really good questions. What's everyone's thoughts? I can see people are still here. Would you guys like to stick around for 10 minutes? Maybe? And just we'll finish off the mistakes? Or what are we thinking? And how are you, Ash and Roger? Like, are you guys okay to stick around for 5-10 minutes?
Yeah.
Yeah? Beautiful. Yeah, why don't we get through it? So, mistakes. Ash, rapid round. What are the mistakes you're seeing, my friend?
Look, again, it depends on the profile. So it depends if you're a first-time investor, if you've got the one property, you're looking at the second property, if you've got a portfolio. Again, it depends. But super quick answer is, again, getting the wrong loan structure. So we've spoken about the structure of the ownership structure, buying in the entity, personal name, but the loan structure is equally important as well, right? So again, understanding the difference between principal and interest only. Banks look at servicing based on a few different ways, right? So they look at some lenders look at your actual repayments and add a little bit of an extra buffer on that. Some lenders will look at how much you've got left on your existing term and add a stress test on the back of that as well. So again, understanding your loan structure and making sure you're buying in the right loan structure is extremely important, not just for that loan itself, but obviously, again, for the next one and the one beyond. Look, the other one is also cross-collateralisation. Again, it's a very technical term, particularly when it comes to that early stage when you're looking at getting your second or third property. It can be very convenient to kind of just get all your properties in the same lending with the same lender where everything's cross-collateralized. So essentially what that means is you limit the flexibility that you've got. You're not in control. The lender is in control. If you want to access your equity, you can't. So I've seen many scenarios, and I'm working through quite a substantially complex one where an investor's got essentially 10 properties cross-collateralized with the same lender. So again, it can be a convenient way, but ideally you want to make sure you've got standalone loans, standalone properties. If it has to be separate lenders, so be it as well. But that's another one you've got to be very mindful of. It can be convenient, but it's actually going to stop you with your plans if you're cross-collateralized. So that's probably the other one to call out quickly.
Can I just have a quick comment on that? So, speaking of cross-collateralization, so one of my very first brokers that I work with, probably not the savviest fella. I remember distinctly having this conversation with him when I was buying my third property, and his strategy for me was to cross-collateralize all three of them because it just made the lending process a little bit easier at the time. I didn't know much about it. Luckily, I don't know what actually prevented me from going down that route. But now that I look at it retrospectively, I was just like, that would have stopped me dead short. I would have had to sell one to pay off the debt. And it just brings about all of these complications that would have completely. So again, maybe a good reminder that having the right person, it's not just about having a team around you, it's about having the right team around you. Because a lot of people will potentially steer you in the wrong direction, either because they are uneducated themselves or ill-educated themselves, or there's something else nefarious going on. But yeah, I'll leave it there. So yeah, I've almost had that happen to me. Roger, from your perspective, what's happening in the market in terms of mistakes? Sure. Yeah. Yeah. That was a really good point. I think, and I'm probably encroaching your territory here a little bit, Roger, but I think the consequence of getting your structure wrong, in a nutshell, is if you buy it in the wrong structure and you try and transfer it in the future, correct me if I'm wrong, Roger, you trigger stamp duty. It's basically like selling to a different person. You might be the director, you might be the thinger, but it's basically triggering a whole new transaction. So you're now incurring double the stamp duty, double the legal costs, whatever it is, all because you're retrospectively trying to fix something that should have been ideally looked at, when you first bought it. This is why it's really important you have the conversations early and not retrospectively, because I can't think of anything worse than trying to set up your SMSF when you've already put, a signature to the dotted line. I literally can't think of anything worse. That makes me anxious just thinking about it. So yeah, yeah. Yes. Treat it. Yeah. 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 Yeah, exactly. And Georgie, really, really good question. I'll give you an answer that is very personal at the moment. So I'm selling a property right now in Townsville. So Townsville's done really well over the last couple of years. I'm selling a property right now. A few days ago, I realized that the property that is being bought, this is in relation to your question, Georgie, what mistakes have you seen with SMSF purchases? So I'm selling this property. A couple of days ago, I found out the person who's buying it off me is buying it in their SMSF. Okay. Now I'll tell you what the mistake is that this person is making, and really it's the buyer's agent that sits behind it, is making on behalf of the client. This is the furthest property that you should be buying in your SMSF. This is the worst kind of property that you buy in your SMSF. Why? Because it's structurally, pardon my French, shit. It has a shit ton of work that it needs. And there's just a bunch of different complications with the property. And I bought the property for a very specific reason. Now, can I go and make those changes myself? Sure, I can. But this person is now getting into a transaction, getting into a property that is completely ill-suited for SMSF. So it's actually very topical, Georgie, because of your previous question. So as you sort of navigate the property world, I'm assuming your SMSF is set up. As you sort of navigate the property world in the next 3 weeks, due diligence, my friend, is going to come in, is probably the number one thing for you. Whatever property you find, just make sure you look under the hood and make sure that it actually stacks up as an SMSF property, which is very different to a property that you might buy in a trust structure or like a personal structure, because there is a lot of limitations in terms of what you can do. You can't add value when it comes to SMSF property, or it's really strict. ATO can really come after you. So be really, really careful. That's probably the biggest mistake I've seen, SMSF, and it's the very property that I own, and it's happening on the other side. So yeah, hopefully that helps. Gents, how about we wrap things up there? I think it's been a really, really good conversation. I know we have parts 2 and 3 as well. And for anyone who's still on the call, we'll obviously shoot through the document that we spoke about at the start of the call and through the sort of emails that we sent. You know what I would actually love? I'm kind of doing this a little bit. I haven't actually talked to you guys about this, but I know we had a thought about what 2 and 3 would be like. But because of the fantastic questions we got, we didn't actually need any talking points that we wanted to get through. I think the questions answered them really, really well. Why don't we do like a poll or something about what people want to see in number 2 and 3, just so we can tackle those, maybe even make it a full Q&A. We don't even come in as people who are delivering info. We can do it via questions. If you guys are okay with that, maybe we'll put through some Q&As in the next sort of whatever email that goes out. And then, yeah, we can come prepared answering those questions. Something like that. I don't know. I just made it up. I have no idea. Yeah?
Happy with
Everyone?
it. Sounds good.
Perfect. Gents, thank you so much. I know you guys are busy. I know time is crazy at the moment. I appreciate you guys being here. I think this was fun purely because I get to talk about something I love with people who love their jobs as well. Hopefully we were useful as well. Hopefully it answered some of the questions that have been sort of percolating in your heads. I know the document's going to be useful, but again, provide any feedback. If you have questions on the back of them, email us back. I'm sure we'll be very, very happy to, answer them as well in that capacity. And if you feel like any one of us sort of fits the parameters of who you want to be working with, there'll also be our details in there. So you can always reach out to us and, have those early conversations as well. So what do you guys think? Shall we wrap it up?
Let's wrap it
Beautiful.
up.
Yeah, thank you so much.
Mate, thank you to you and your team for organising and pulling this together as well, mate. Appreciate it.
You're very welcome. And big thank you to Nathan in the background, who's done a ton of work, and Jahan as well, who's unfortunately a bit unwell. But the boys did a fantastic job of pulling this together. Thank you so much. Yeah. Yes. Absolutely. Absolutely. That was fantastic. Thank you so much, guys. We'll see you in the next one. See you guys.